This is Value Investing. I'm your host, Jun Kim. In this podcast, you'll learn everything related to value investing. Hello, value investors. Welcome to episode 21 of Value Investing. So far, we have discussed a lot of topics related to Warren Buffett in terms of how Buffett started his investment partnership, what are Buffett's 6 investment criteria, and how he defined owner earnings, and so on and so forth. There are still a lot of topics left with respect to Warren Buffett. I was thinking about, why don't I just finish all these topics first and move on? But I decided to change my mind and switch gears a little bit and talk about something else and see how you guys react to new value investor that I'm about to talk about. The new value investor that I like to talk about is Joel Greenblatt. Joel Greenblatt probably is not well known to average people, but he's definitely well known to value investors. Joel is the founder of the New York-based Gotham Capital, a private investment partnership whose stock portfolio has achieved returns of $52 for each $1 invested at its inception. In 1985, Joel started a hedge fund, Gotham Capital, with $7 million, most of which was provided by junk bond king Michael Milken. Through his firm, Gotham Capital, Joel presided over an impressive annualized return of 40%. Yes, you heard it right. 40% from 1985 to 2006. So this is just a crazy return. If you look at Warren Buffett's long-term return, over the 30 years, I think he got around 20% annualized return. So it's really extremely hard for Warren Buffett to achieve this one for a long period of time. So even if you take into account the time period, still Joel Greenblatt was able to achieve 40% annualized rate of return for his clients. So he's definitely has been successful running his hedge fund for his clients. And Joel has written multiple books, but here in this episode and the following episodes, what I like to do is talk about a book called You Can Be a Stock Market Genius. I usually don't like a book with like flash title because it sounds like scam, but this book definitely is something that I recommend. I'm going to put a link which you can go to and buy this book, and the book price is only less than $10 from Amazon. So definitely worth reading. But if you're a type of person who doesn't like to read, then it's fine. I'm going to cover most of the topics in this book, and it's definitely worth listening to these episodes in the near future. What I liked about the book is the fact that Joel talks a lot about special situations such as spin-offs, restructurings, mergers and acquisitions, rights offerings, and so on and so forth. So these are the topics that I was not familiar with, and I was able to learn quite a lot from the book. So I think it's going to be definitely helpful if you're not really familiar in this area. But in this episode and the next episode, what I'm going to do is I'm going to cover some investment basics that Joel thinks that you have to know as a value investor. And after 2 episodes, I'm going to cover some of these special situations that you may not be familiar with, and you definitely will be able to learn quite a lot from these podcast episodes. Before we get started, let me give you a disclaimer that this podcast is for entertainment purpose only. It is your responsibility to consult with your investment professional for any investment decisions. Also, I want to mention that 5-star review goes a long way on whichever platform you listen to this podcast. This podcast is available on most podcast platforms such as iTunes, Google Play, Stitcher, TuneIn, and Spotify. And if you want to leave your comments or any feedback, please do so at valueinvesting.blueberry.net. Blueberry is spelled as BLUBRRY. This is my podcast website, and I read every comment and feedback and try to incorporate the feedback into the episodes that I make in the future. Without further ado, why don't we get started? As I mentioned, in this episode and the next episode, I'm going to talk about investment basics that Joel thinks that we need to know as a value investor. In the book, he laid out 7 investment basics that a value investor should know. Let's just go one by one. First, Joel said that we have to do our own homework. So there are 2 reasons for that. First, we don't have any choice, because if you are truly looking at situations that others are ignoring, there will rarely be much media or Wall Street coverage. So nobody's looking at the investment. That's why it creates investment opportunity. So think about it, and think about from common sense perspective. Because if there's a lot of media coverage, and if the company is very large in market value, then a lot of analysts will try to cover the company, and the investment opportunities will be very slim. Because by the definition of more large market cap and large coverage, a lot of people have already done the analysis, and there are a lot of smart people, intelligent people, throwing a lot of resources and people to do the analysis. So as an individual investor, it's not likely that you'll find a lot of great investment opportunities in this space. I'm not saying that there's no investment opportunities for large market cap companies with a lot of media coverage, but you just have to find something that other people have ignored that gives you mispricing of the stock and gives you investment opportunities. The second reason why you have to do your own homework is because you don't want to get paid for merely taking big risks. You want to maximize your returns while at the same time minimize your risks. How do you do that? As I mentioned, you have to do your own homework and try to find out mispriced opportunities that are out there in the market. Whether you read the annual report of the company that you're interested in, or looking at other aspects of the company that other people have ignored. So that was the first investment basic that Joel mentioned in his book. The second investment basic that he mentioned is don't trust anyone over 30. And the third investment basic that he mentioned is don't trust anyone 30 or under. Did you get it? So what he's trying to say is that the odds of anyone calling you on the phone with good investment advice are about the same as winning lottery without buying a ticket. So basically none. So let's think about where a lot of people get their info regarding the companies that they are trying to buy. So they can just do Google, or they can go to Bloomberg Terminal, and there's just a lot of coverage if the company is large cap. But if you look at the analyst community, where a lot of information is coming from, because their job is to analyze these companies in an objective manner and provide some recommendations to the public investors. But is it really working that way? No, that's not. So that's what Joel is trying to say. He said that there's overwhelming incentive for analysts to issue buy recommendations on whatever companies that they are covering. There are 3 reasons why this is happening. The first reason is very obvious. The vast majority of analysts are not directly paid by the people that they are supposed to serve. The way that they are making money is by getting commission fees, such as investment banking fees from potentially the companies that they are covering. So there's a conflict of interest here. They don't want to give negative rating, offend their potential clients, and ruin their commission businesses. So this is the first reason why analysts are likely to issue buy recommendations for those companies. The second reason is that even if the analysts want to remain independent, if they provide negative coverage, they get cut off from an important source of information. The management doesn't like the analysts and doesn't want to provide any meaningful information to those analysts giving negative rating. So this makes the job much more difficult for analysts to remain independent. The third reason, this is not obvious one, but it is true, is that it's extremely hard to go against the crowd and publish a sell rating when all fellow analysts think differently. You're gonna look stupid when others are right, and you can potentially risk losing your career. Because if you go with the crowd, it is safe. Even if the crowd is wrong, it's not just you saying that this company is bad, but everyone else was talking about the same thing. So you have an excuse. But if you're the only one issuing sell rating, then you're going against the crowd. And if you're wrong, at the end of the day, you might look really stupid. So this is why Joel said that there's a lot of hold ratings instead of sell ratings. A lot of buy ratings, a lot of hold ratings, but you rarely see sell ratings from analyst reports. So we just talked about why analysts have strong incentive to issue buy recommendations instead of sell recommendations. Aside from that, also most analysts cover only one industry group. So they don't really know how to compare the companies that they are covering against other companies in different industry. So if you're an investor, your job is to assess every single situation and try to find out the best opportunity. But if you look at analyst report, they're only talking about companies that are in the same industry. So even if they have strong belief that this is a great investment, they haven't really looked at other companies in different industry which may have better prospect in the future. What about listening to your friends, family members, or people you know or you have respect? First, they don't really have expertise in analyzing companies. And second, even if the person that you know is Warren Buffett, you never know when he or she will sell their stocks. So they can say that this is a great stock and you truly believe the person's analytical ability. You never know what actually drove him to identify this stock as undervalued stock. And also, you never know when this person is going to sell his or her position. So the best way that you can avoid this problem is going back to the first investment basic, which is doing your own homework. Don't trust other people and just do your homework. So that's kind of the bottom line. So we just talked about 3 investment basics. The 2 and 3 are basically the same thing. Don't trust anyone over 30. Don't trust anyone 30 or under. The next investment basic that I want to talk about here is pick your spots. This is quite similar to the concept that Warren Buffett introduced in his interview or in his investment letters. Warren Buffett has often said that you only need to swing at one of 20 pitches. So he actually brought in some baseball metaphor here. So there are no cold strikes on Wall Street. Wait your pitch. You don't have any concept of strike when it comes to investing. You can just wait and you can just pass all the investment opportunities if you don't know and if you don't understand, and try to wait for the ones that you truly understand. And this is the concept that a lot of people know as circle of confidence. And if you're a value investor, you probably are familiar with this concept. But the problem is, even if people know in their brain, in their head, they don't really act on what they preach. So you have to have discipline in order to implement these strategies correctly, and you need to be patient. It makes sense that if you limit your investments to those situations where you are knowledgeable and confident, then you're going to be successful. But as I mentioned, it's not easy. Here, I want to talk about the argument for diversification, because this doesn't really go hand in hand with diversification strategy, because diversification strategy is all about investing in many companies so that you minimize non-market risk. So there are two types of risk that academia is talking about. The first one is market risk, also known as systematic risk. And the other one is non-market risk, also known as idiosyncratic risk. So market risk is driven mostly by factors related to overall market and macroeconomy. And non-market risk pertains to risks involved in specific company. And here's some interesting statistics that you need to look at. Statistics say that owning just two stocks will eliminate 46% of non-market risk of owning just one stock. So the reason why people want to diversify is because they want to reduce non-market risk as much as possible and only take on market risk. But if you look at statistics, the way they calculate the risk and reward is a little bit different from how Warren Buffett and other value investors are defining risk and return. However, if you look at their result, they're saying that if you own just two stocks, that's going to eliminate 46% of non-market risk. If you own four stocks in your portfolio, you're going to remove non-market risk by 72%, and 82% with 8 stocks, 93% with 16 stocks, 96% with 32 stocks, and 99% with 500 stocks. Here, what Joel is trying to say is that after purchasing 6 or 8 stocks in different industries, the benefit of adding even more stocks to your portfolio in an effort to decrease non-market risk is very, very small. Marginal benefit is very small. So it doesn't make sense to just add just purely for diversification purposes. Overall market risk will not be eliminated merely by adding more stocks to your portfolio. So that's another point that you want to keep in mind. So if your goal is to better than the market, which is not easy, you have to pick your spots and swing only when you have the right pitch. And if you're trying to buy thousands of stock in order to diversify away non-market risk, the problem is you cannot really pick spots. You cannot really understand 500 or thousands of stocks in your portfolio. There is no way you can understand them all. And as I mentioned, the benefit of diversification is going to go down significantly after having more than 8 stocks. So your goal is to better than the market, and your goal is diversify away a significant portion of market risk. Then you can have 8 stocks in your portfolio and still you can understand all these different 8 stocks, and that's your goal. So in this episode, we talked about 3 things. First, we talked about why it is important for you to do your own homework when it comes to investing your money in stocks. Second, we talked about why you should not listen to other people and why it is bad for your investment decision. Third, you also need to pick your own spots in order to gain some competitive advantage in the market and be better than average. And diversification is good, but only up to a certain extent. These are really basics, so you might think that, oh, I already know all of this. Even if you know, I think the important thing is not about knowing, but it is more about implementation. So think about the investment decisions that you have made in the past related to these 3 investment basics. in my case, I usually do my own homework. So the first one, I usually pass. But in terms of the second item and third item, sometimes I listen to people or analysts. So even if I buy some really great companies, and if I go online and read some negative coverage, then I may get influenced by these negative articles and news and thinking twice whether or not I made the right decision. So I really have to watch out for this second item and just stick with my rationale and the logics that I came up with when I first purchased the stocks. The third item related to picking your spots. Sometimes because of fear of missing out or because of greed and fear, I sometimes go beyond my spots. The question that I have to ask myself is, do I really understand the stocks that I'm buying? Do I really understand whether or not this company has some competitive advantage in the market? Do I really understand in terms of long term if this company is going to perform well? Do I really understand if this company is undervalued? I have to ask all those questions just to make sure that my confidence level is high. I need to know whether or not I stay within my circle of confidence. Okay, that's it for today's episode. Today we talked about relatively simple investment basics. Do your homework, don't listen to others, and pick your spots. But as I illustrated just a moment ago, it's important for you to completely instill all these concepts into your investment practice by 100% aware of what's going on in your brain and also in your emotions. So that's what matters. I hope you enjoyed this show. In the next episode, I'm going to talk about some more investment basics. And after that, as I mentioned, I'll cover topics related to special situations such as spin-offs, mergers and acquisitions, and so on and so forth in the book written by Greenblatt. Thank you very much and see you next time.